So let's take a look at an example of some costs, and let's classify them as either direct material, direct labor, or manufacturing overhead if they're a product cost, or are they a period cost. So it's a dairy processing company. Okay, so that's their product is making gallons of milk. So the cost of the milk that was purchased from dairy farmers, that's going to be a product cost, right? And that's going to be considered the direct materials, is the milk itself. The depreciation on the marketing department. So the marketing department, think of that on the value chain. That doesn't have to do with production. Okay, that's going to be a period cost. The property tax on the dairy processing plant. Okay, so it has to do with the plant, the manufacturing plant, so it's going to be a product cost, but we can't trace the property tax to a specific gallon of milk, so that's going to be considered an indirect cost, which is manufacturing overhead. The gas used to operate the refrigerated trucks that are delivering the gallons of milk to the grocery store. Okay, so that doesn't have to do with manufacturing. That's going to be the distribution. That's a period cost. How about the company president's annual bonus, right? That doesn't have to do with manufacturing either. That's a period cost. How about the depreciation on the refrigerated trucks used to collect the raw milk from the local dairy farmers? That's going to be a product cost. Okay, because that's part of getting the raw materials. That's part of the cost of acquiring it. So that's part of actually the manufacturing process, and that's going to be considered manufacturing overhead. How about the plastic gallon containers that we put the milk in? So the plastic jugs for the milk. That's going to be a product cost. And it's going to be a direct material because we could trace that cost, the cost of the plastic gallon container, to a specific gallon of milk. How about the research and development on improving the milk pasteurization process? That's going to be considered a period cost. How about the advertisements for the products? That's going to be a period cost. How about the lubricants used in running the bottle machines in the factory? That's going to be a product cost. That's a cost in the factory. That would be part of manufacturing overhead. We can't trace it to a specific gallon of milk. It's going to be, the machines are going to be used to run, to put together all kinds of gallons of milk. Whoops. How about the wages and salaries paid to the operators? So the machine operators, that's a product cost, and that would be the direct labor of putting together the gallons of milk. So those are examples of the period versus the product. The product costs are the direct materials, the direct labor, and the manufacturing overhead, and those become asset accounts initially. They don't hit the income statement until they're sold. The period costs are the selling and administrative expenses that we classify as operating expenses on our income statement. Some other definitions. We've got prime costs and conversion costs. Prime costs, those are the direct costs, direct materials and direct labor. Conversion costs, this classification will come into play when we talk about process costing in Chapter 5. So the costs incurred to convert raw materials into the actual product. So direct labor and manufacturing overhead are the conversion costs. And so we'll deal with that in a later chapter. All right, so now we want to take a look at the income statement. So let's review the income statement we learned back in financial accounting, right? So in financial accounting, the very first chapter, we learned about service companies and we learned the income statement. And so this was the simplest income statement where we took our revenue minus our expenses. That's how we got to, we called it net income, but that's what we're calling operating income. And so this is a very simple income statement. We don't have any product costs for a service company. All the costs are period costs, so they're being subtracted here as operating expenses. For a merchandising company, okay, so this is where it got a little bit more involved, and I just actually had shown you in the last video, reminded you of that. So we started off with our sales revenue. We subtract our cost of goods sold. That got us to gross profit. Then we subtract our operating expenses, and then that's how we got to operating income. Okay. Now the cost of goods sold, back in financial accounting, we learned how to compute that if you are if you're using the periodic method. So to get our cost of goods sold, we take our beginning inventory, what we started the period with, plus our purchases, so what we bought from our supplier. So whatever we started the period with, plus whatever we bought, that's what we had available for sale. Now we're also adding in our import duties or tariffs, any freight in, that all becomes part of the purchases. But that's how we get our cost of goods available for sale. So what we have available to sell, either we sell it or we still have it. So if we subtract our ending inventory, that's how we get to our cost of goods sold. And so that cost of goods sold amount, that's how we got the cost of goods sold that we were reporting on the income statement. Okay, so that's what a merchandising company looked like. What we want to do now is look at a manufacturing company. And so the setup is the same, right? The income statement is going to look the same. It's just cost of goods sold is going to be different because we're not buying the product. We're actually making it. So we're not going to be able to just add purchases. Okay? We're going to have to add the cost of the goods that we manufactured. So let's take a look at how. So to calculate the cost of goods that we manufactured during the period, we're going to start with our beginning work in process inventory. We have whatever we ended last period with the products that we were still working on, right? The first thing we would do this period is we'd finish them. So we take the beginning work in process inventory, and then we're going to incur direct materials, direct labor, and manufacturing overhead to finish those products, but then to also make new products. So that beginning work in process inventory plus the direct materials that we used during the period, plus the direct labor, plus the manufacturing overhead, that gives us our total manufacturing costs that we need to account for. Okay. But some of those costs are sitting there in the work in process inventory, those units that we haven't finished this period. Right? So we're going to subtract those out because those aren't all the way done. And that's how we get to our cost of goods manufactured. And so we're going to use that cost of goods manufactured when we get our cost of goods sold. It'll be our beginning finished goods inventory plus the cost of goods manufactured. That tells us what's available for sale. Then we subtract our ending finished goods inventory, we get to our cost of goods sold. But another thing we do need to compute is our direct materials used. Okay? Because just like we saw with our finished goods inventory, right? We start the period with finished goods inventory from last period, and then we have some finished goods inventory on hand at the end of this period. Same with our work in process. We have some of our inventory we start the period with, right? Whatever we ended last period with, we start this period with. And then we're going to have some work in process inventory on hand at the end. The same thing's going to happen with our raw materials inventory. And so some of that direct materials that we buy during the period, that may still be sitting there in inventory. We would only want to be accounting for the direct materials that we used as part of the manufacturing process. So to figure out the amount of materials that we used, we take the raw materials inventory we had at the beginning of the period, and then we add the raw materials that we bought during the period. So any of what we paid for the raw materials plus the freight costs on acquiring those raw materials, okay, That gets added to the beginning raw materials inventory. That tells us the materials that we have available to use. So of the materials available to use, either we used it or we still have it. If we subtract our ending raw materials inventory, that tells us our direct materials used. And this is the amount that we use in the calculation of our cost of goods manufactured. So let's take a look at working our way to computing the income statement. So we have to prepare our direct materials used schedule first. We need to calculate the cost of goods manufactured and the cost of goods sold before we can get to the income statement. So let's do the direct materials used. So the first thing we want to show our beginning raw materials inventory. We're told it's $27,000. We're going to add to that the purchases of direct materials, which we're told is $79,000. That's going to give us our materials available for use. We subtract our ending raw materials inventory, which we're told here is $31,000. That gives us $75,000 as our direct materials used. After we have our direct materials used, then we need to calculate the cost of goods manufactured. So we need to know the beginning and ending work in process. We use that direct materials used from the schedule. We need our other manufacturing costs, direct labor and manufacturing overhead. And so our manufacturing overhead is our indirect materials, indirect labor, and then our other manufacturing overhead such as plant utilities, depreciation on the plant, etc. So our manufacturing overhead in this example here is going to include our indirect labor of $46,000. Our insurance on the plant is manufacturing overhead. Depreciation on the plant, building, and equipment, $12,700. Repairs and maintenance on the plant is also manufacturing overhead. Okay, marketing expenses and general and administrative expenses are not manufacturing overhead. Those are going to be period costs because those don't have to do with manufacturing. So now we can calculate our cost of goods manufactured. We take our beginning work in process, we're given as 43. Then we're going to add our manufacturing costs. Direct materials used, we pull that from the schedule that we prepared. We add our direct labor that was given to us at $83,000. Our manufacturing overhead that we computed by adding together our indirect labor, insurance on plant, depreciation on plant, repairs and maintenance on the plant. And we get our total manufacturing cost to account for by adding the beginning work in process plus the manufacturing costs. Some of these manufacturing costs are still sitting there in our ending work in process inventory in those units that are partially done that we're going to finish next period. So we subtract that to get our cost of goods manufactured. Now we can go and complete the cost of goods sold. So our cost of goods sold, we take our beginning finished goods inventory. We add the cost of goods manufactured from that schedule. That tells us what we had available to sell. What we have available to sell, either we sell it or we still have it. So if we subtract what we still have, our ending finished goods inventory that was provided to us, that gives us our cost of goods sold. Now we can go ahead and we can prepare the income statement. So our income statement, our starting point is our sales revenue. So we're told they sold 39,000 units and the selling price was $10. So we multiply the units sold by the selling price. We get sales revenue of $390,000. We subtract the cost of goods sold that we calculated, and that tells us our gross profit. Then our operating expenses, right? And we know we've got marketing expenses, those are our selling expenses. We've got our general and administrative expenses. Those are added together to get our total operating expenses, which are then subtracted from our gross profit, and that's how we get our operating income. So that's how you do the income statement for a manufacturer.